Welcome back. Today, we are going to be talking about some of the trends that are coming into 2026. The big three that we're seeing is that the economy is getting some really good momentum at its back. We're going to be diving into that. We're also going to be diving into built to rents, that there's up and coming new builds and there's some new momentum happening there. And also, some of the smaller to medium sized markets are actually outperforming some of the larger markets. These are the three main trends we're seeing right now coming into 2026. And John and I are going to be breaking this down in today's podcast. John, it's great to be here with you.
So good, Mark. Yeah, I'm so excited. It's 2026. It's a new year and new opportunities, right? For me, it's interesting because I'm not a big like New Year's resolution person. Like I feel that, you should always be working, on improving or sort of like, setting those goals like in a consistent basis. And we know a lot of New Year's resolutions fail. It's interesting because what I found, at least for myself, is it's really something I saw Arnold Schwarzenegger say recently that I thought was so good. He's like, motivation is tough because motivation comes and goes. Some days you wake up just fired up and motivated, but what do you do on the days where you don't have that motivation, right? And so it's really about establishing routine and habits. So you might say discipline, but I actually like routine a little bit better because discipline implies other things where it's just knowing that like my day is planned out. I wake up every morning, Monday, Wednesday, Friday, go to the gym at 7 a.m., and it's just all these things are just sort of built into my habits. And so that said, as we approach 2026, of course, we're thinking about goals for the team and for the company, for our investors and for our residents, and that clarity around our goal of helping 500 residents experience the best living experience in the world is something I'm super excited for. So looking forward to not only this podcast, but this year.
Yeah, I love that, John, about focusing on routine versus like hardcore discipline. It's just like I wake up and these are the things that I do.
Yeah.
The more you can get into routine and habits, the less focus and we'll just say energy you have to put into it. So I love that. One of the things that I caught on to this year was I went to lunch with one of our larger investors, John, and
Mm.
really solid, business minded guy. He's done really well for himself. And he was saying that one of the guys that he was working with, he's not a big believer in these New Year resolutions as well.
Yeah.
It's like, like set the goal and then, January, February starts to fall off. So what he started doing was he started having a word,
Mm.
one word as a theme for the year. And I was like, oh man, that's good. So it's like the whole year you're just focusing on improving on that one word. And so it
Mm.
could be anything. I mean, it could be discipline, could be routine, it could be improvement, it could be fatherhood, it could be
Yeah.
husband, it could be like it doesn't really matter what it is. But when he said that, I'm like, huh. So a couple words came to mind.
Yeah.
One was finish because I have a number of projects that are just sitting there and I made some headway, but I haven't actually finished them.
Mm.
And so that was one word. And the second word was stewardship. And
Mm.
I dove into this idea of stewardship. And so stewardship is it's assigned responsibility to protect, multiply, and make better or improve what it is that you're going after. That's like stewardship. And
Yeah.
so I really love that. I'm like, oh, stewardship. But then it was like finish is there. And I was going back and forth which word. I'm like, maybe I'll pick two words for this year. I was like, no, keep it simple, stick to the program, one word. And so although stewardship still is something that's still top of mind always, finish is the word that I settled on. So that's
I
the
like
word for
that.
2026, finish.
Finish.
Maybe we'll do an end of the year podcast as to what I actually finished this year. I know there's a lot of suspense out there for all the listeners. Like, what
Yeah,
are you
right.
working on, Mark? Right? So, yeah,
Well, I know you've been hard at work at a book and a lot of different things. So
yeah.
that's a good one, man. Stewardship's interesting because I guess you could argue that like being a good steward of your time, you're finishing your projects, right? So I guess it could play into that a little bit.
Oh,
But
I
I
went
like
back and
finish.
forth all
Yeah.
through that and went back, but at the end of the day, yeah, finish was the word. Maybe stewardship's next year. So
Yeah, there you go. I like that. I mean, it's interesting, right? Because, I know known you for a long time and you're a visionary, you're a big thinker. And so I guess the trap could be is you think of all these things you want to do, right? And so it's like just getting that focus to finish that project before maybe moving on to the next one. I love that. Um, speaking of 2026, it's 2025 was sort of a wild year, I suppose, right? With the new administration in the US and we don't have to rehash everything, but sort of the tariff war and creating some tension amongst some of our partners. And in the final analysis, I think the tariffs have been less of a factor than people really thought or realized. The impact on the cost of goods isn't quite there, although we are still seeing some persistent inflation. But I think for me, the clarity of understanding that, political cycles come and go, but the fundamentals of life or investing or whatever, right, they don't really change. And so, for me, just looking at some of the signals right now, I'm really excited for not only our company, but for our investors, our residents. I think this is going to be a great year for investing. And it's that idea, the paradox of investing sometimes is that most people buy at the high point and sell at the low point, right? And so having that ability to kind of see through the noise and sort of reach beyond the headlines and really sort of look at what is happening and why now may be the best time there's ever been to invest in real estate, right? So we're going to dive into some of the numbers we're seeing and a few articles that we read this week that we think would be relevant to our investors.
For sure. So the first one is why 2026 outlook is looking to, we'll say, be a shiny, a little shinier, a little brighter, a little more encouragement than 2025. And so it's really interesting that you can almost sense it in the industry that it's like, it was like survive till 2025, but then it was like, there's another one on 2026, right? And so
Yeah.
this idea about conversations with interest rates coming down, but also the conversations we're having with a lot of these larger equity groups in regards to getting their capital deployed and starting to look for a home to get that deployed is like it's a real thing. And so one of the articles we read here from CRE Daily was that there's projected coming in this year 191 billion in going into the economy with this GDP growth. And actually, in Q3 of 2025, 4.3% GDP growth is what the Bureau of Economics reported.
Strong GDP growth. It's kind of interesting because right now we've had some change up in how the government is looking at certain statistics, but we've seen kind of consumer confidence in some cases lowering. Yet if you look at the numbers, this Christmas season was like a blowout, right? And so it's always interesting, right? Like what did the stats say and what does the reality actually show up? And so consumer confidence is starting to grow again. And I think that once again, whether you like Trump or not, his management style is in your face. And so, he dominates the headlines. And so, the reality is sometimes you just have to wait and see, how does this actually play out? And so that strong GDP growth we saw, annualized through Q3. We don't have Q4 data yet, but based on some of the signals we're seeing in consumer spending, it's also going to be a robust quarter. And so it looks like we'll have some strong growth going into 2026.
Yeah, and it's interesting around the holiday season here. So being down in Naples, Florida, it's just the amount of people that are out spending, John. Like it's incredible, and this is you just watch what people do, right? And so
Yeah.
this is where all the data points, and we're seeing articles, and we're seeing like a lot of we'll say we'll leave it at data points out there. But when you're actually going out and you're seeing what people are doing on a day to day basis, that's another thing to really look at.
Yeah.
Like just look at the herd and look at what people are doing, and there is a lot of spending that is out there. So that I think that bodes very well for the overall confidence level.
Yeah.
And it doesn't hurt that you see the stock market what it's done over the last bit. A lot of people are sitting on uh, cash as well, and that's another thing that they're looking to get it further deployed into real estate, which has been overall there's been a lot of money sitting on the sides from real estate, but a lot of the big money is really looking for to get some we'll say of those dollars placed into high quality real estate assets.
Yeah.
We're just starting to see that trend. So it's boating. It's 2026 is shaping up to be a very strong year.
That's right. And looking at this data, what we're not doing is changing our underwriting philosophy, right? We're still underwriting deals conservatively. If we're expecting some cap rate relief, we're considering that upside. We're not basing our assumptions on that, right? We're still kind of being very conservative with our rent et cetera. And interestingly enough, Jay Parsons, who's somebody I follow on LinkedIn, he's an operator, but he's an economist by trade. And he just literally today, so it was kind of a little bit early or too late for us to incorporate some of his insights, but I'll share is that, you might even see some demand weaken because we are seeing the job market weaken a little bit, which, in truth has been sort of the plan. I mean, that's what the Fed's been sort of doing. When you have too much employment, it's a kind of a dark secret, I suppose, but too much employment leads to inflation and other things, right? So it's kind of finding that balance. And so, but with that, we're seeing such a dramatic cut in new inventory coming online, concessions and things are burning off. So even though in some markets, and by the way, we're buying in markets that are projecting like 5+% population growth, Noonan 10 plus. So we're still using the core fundamentals of how we select our areas and assets to make these decisions. But you add to that, like if there was a little bit of pressure, because of that wave of inventory, we're actually lower in terms of new inventory projected to come online in 26 than we were pre-pandemic. So that's going to provide some great tailwinds as well. Trend number two is something to really pay attention to. Now, part of our strategy of buying older assets built in the 80s, 90s, and early 2000 and improving them is not going to make BTR too much of a concern for us. And when I say BTR, I mean build to rent. So these are single family homes or townhome neighborhoods and communities that were built for rental purposes. And Mark, I had a kind of a front row seat when all this started happening because at my prior company, Mark Spain Real Estate, we were working with a lot of these institutional investors that were buying single family home rentals, but they were buying one at a time. So like Invitation Homes bought a few hundred thousand one at a time. And so over time, companies like America Homes for Rent and even Invitation Homes started looking at the economics and realizing it might make sense just to buy a whole neighborhood or whole community. So they would partner with, groups like Pulte or Taylor Morrison. And so what's starting to happen now a few years in, because this started kind of in like 2012, 2013, and in my memory, it might have been a little bit earlier than that, but I specifically remember driving through Charlotte and seeing a sign saying new homes for rent. And I was like, I've never seen that before. And so all that said, that is starting to grow because we've shared this on the podcast before. But the average home buyer in the United States went from 27 to 38 in the last 5 years because the cost of housing has risen. You add that with the increased rates. Now we're seeing some relief there, thankfully, but it's just harder and harder for people to own that first home. Average buyer is 58 years old. So all that to say, it's a sort of a thing that's needed, right? I remember when it first came out, there was some people that were concerned around it, but at the end of the day, everybody in my mind deserves quality, affordable housing. And if build to rent is the way to achieve that, that's great. So, for example, in Noonan, where we own an asset, most of the new product that's being built, or really, I should say, being approved by the municipality, is built to rent. They don't want a bunch of multifamily apartment communities. And what's beautiful is they're starting rents at $2,400 for like a 2 bedroom or a 3 bedroom, two bath, where we're able to offer 1,800 to 2,000 for something that's similar size. Yes, it's a few years older, but we're renovating it, improving it, and making it as equally nice. But it's something to pay attention to. And what we're starting to see now is consolidation, where there's like six of these groups that are doing the majority of the building. So nothing that's really impacting us, but it's just interesting to watch. So there's 100,000 build to rent apartment or homes, I should say, already in operation today, 140,000 in planning stages, 64,000 under development. So it's definitely a trend we're paying attention to and making sure that when we're buying, that whatever we're going to deliver in our post renovated rent is still very competitive and really attractive as compared to that build to rent. Because if we found ourselves in a situation where we were targeting rents that were similar, I think a lot of renters or residents would choose that build to rent over an apartment, right? So it's definitely something you got to be mindful of. But right now it's not a threat to us, but it's something we're paying close attention to.
Well, John, I think this just reinforces our overall approach of buying, we'll say, well below replacement costs apartments. And I mean, the trend wise, I mean, look at 120,000 built to rent in operation today, and 64,000 are going to be delivered by 26 and 27. And then you have 140,000 in planning stages, means that there's a ton of need for rentals. Like we're becoming more of a renter nation, and that's a fact. And so you see all this coming down the pipe. But if you see all this coming down the pipe, it's telling you yes, there's more rental demand that is expected to come. More and more people can't afford to purchase. But this just reinforces the fact that and we know that pricing is going up. and more people can't afford those, like you said, the $2,400 a month. So this is where when you're buying well below like half of replacement costs, like, so for example, we're buying like anywhere from, 100,000, $150,000 per square foot. And to rebuild that, you're paying 300 to $350 a square foot all in. And so when you're buying below half of replacement costs, means you can charge less for all these renters that are more and more, because we're becoming more and more of a renter nation, and affordability is becoming more and more important with inflation. So it just reinforces our overall thesis on
Yes.
buying these value add buildings at great cost basis. And then once you renovate and increase, you're still affordable, which is
Yeah.
serving such a need in the marketplace today.
Absolutely. So, at the property level, we're mindful of our curb appeal, making sure, we're pet friendly, good parking, good lighting. But the main thing is just high quality renovated units at an affordable cost, right? And so we stand tall compared to those newer build to rent assets in the area. Not all areas are seeing this. I mean, to do this, right, it has to be affordable land. So you're typically seeing on kind of secondary or tertiary suburban markets. So once again, areas like Tampa aren't seeing a big wave of this stuff. It tends to be in smaller markets, but definitely something we're watching. But to your point, Mark, I think it just affirms our strategy. With that deep discount to replacement cost that we're achieving with these older deals. Trend number three is, the smaller and mid-sized metros, right, where you're seeing a lot of the rent growth, you're seeing population growth, job growth in some of these markets, and I think Charleston's really a great example of that in a market we zeroed in on pretty early when we started the company. But those are markets we're continuing to focus on. Noonan, going back to that example, 10-year population growth projected in the next 5 year, 10%. And then it's already achieved 20% over the last 10 years. So, trending 10% and, growth every 5 years in terms of population. Those are the kind of markets we're looking for, right? Where we can find good quality assets that need a little loving care and put our value add strategy in place.
There's a really interesting article that from Globe Street here that said that the regions that they're performing best are the ones that are optimizing for their workforce and the quality of the area as well. And when it comes down to employment, not just their population size. So it's very easy to go into a city and just look at straight population size and say, that's going to perform well. The ones that are doing better are really building diversification in their employment, and they're going deeper in, from a strategy standpoint of what are we doing different to make our city, we'll just say, have deeper roots so
Yeah.
that it can continue to thrive and grow. And a big part of that is diversification. So Vegas, for example, Las Vegas, they're not only tourism now, but now they're like logistics. They're big on clean energy and manufacturing as well. So
Yeah.
the cities, they're a lot of them have been quite smart with how they're growing, and they're growing in a more strategic overall way to reinforce the roots of the city. And those cities that are thinking this way and approaching their growth this way are excellent cities to invest in. And a lot of them are the smaller to medium sized
Mm.
markets when it comes to population, not like the extreme large cities.
Yeah, and states like Texas, Utah, Georgia, and Indiana have a high supply of these types of markets. So we've looked a little bit at Utah, but Georgia, Texas, and even Indiana, we're digging into a little bit. You and I, on our meeting prior to this, we're talking a little bit about Indianapolis. So those smaller metros, right? That location competitiveness, better cost of living, workforce agility, and livability, right? I think that's such an important factor. I mean, I'm in a suburban market very close into Atlanta, so. But when I look at what's happened in the last 10 years, where we have a 14,000 seat amphitheater here, there's kind of rumors of an NHL team. Mark, I've heard some things that suggest it might be coming to Atlanta, but in my back
Yeah.
door, I know, yeah, yeah, rumors and innuendo,
Yeah.
but we'll
Yeah.
see.
Yeah.
But all that said, like the downtown area now has like 30 restaurants, bars, shops. I mean, you go down there any night of the week and there's, a couple thousand people hanging around with their families in the green space and grabbing a bite to eat. And so that livability is so critical. And a lot of these smaller markets are better able to handle that and do that. The behemoths like Atlanta, I mean, to fix their problems is going to take, we'll just keep waiting. I put it that way. But you take Alpharetta, a city like I live in, and they're very agile and quick and can make those decisions. And we have 100,000 people that come here to work every single day, that commute to the city for work itself. So finding those pockets is top of mind for us.
For sure. And this is where I think it's really good to just reinforce the point. Like Alpharetta, for example, a city outside of Atlanta. People look at Alpharetta and it's just like that's all Atlanta. It's like Noonan, our last asset, 114 units we closed on. Noonan's like half an hour from Atlanta, but population's like 45,000 population. That's what we're talking about. We're talking about like these secondary and tertiary markets that are drive from the main city. Those are areas as well that are like they're small, they're cities with close to larger cities as well. And so these are areas that have done really well with really strong leadership. And that's one of the things that we do really well, John, is in our research and analysis of the different cities when we're going in, is to find these pockets that have these tertiary and secondary markets that are really we'll just say have really strong upside and strong leadership and strong policy. And this is something that we're seeing this coming in 2026. It's those cities and those areas will continue to outperform some of these larger cities, and it's a really exciting time to be in real estate.
Absolutely. So what we're watching is just how fast does policy equal growth, right? So how fast can those changes on the fiscal level and from the Fed in terms of interest rates really pass through to financing conditions and depth in the marketplace. BTR just something you and I were talking about earlier, but like quarterly, like looking at every one of our assets and seeing what's in the queue in terms of new developments in the area and making sure we're well ahead of that. So if we see a wave coming, perhaps speeding up towards a little bit of an exit. And looking at those small metro areas for where are the payroll trends heading, the permits, insurance quotes, like just testing that competitiveness, durability. One thing we're always doing is we have an analyst, and when he doesn't have a deal to review, he's looking at submarkets. I mean, just going through and just kind of building a database so we can make fast decisions. So at the end of the day, Mark, I think 2026 is going to be a really good year, not without its challenging. I do predict we'll still see some challenges with deal flow. A lot of operators that bought at the peak of the market are still in pain, to be very clear. A lot of the data we're seeing on refinances is the banks are looking for capital to be brought in. They want to see skin in the game. So operators that have a good track record of success, that are well capitalized, have equity in the deal, and potentially can put more equity in, are going to get those refinances. So some of that could lead to opportunity for us, right? At the end of the day, if there's some foreclosures or things like that, that's acquisition opportunity. So I don't think this year will be a cakewalk when it comes to acquisitions. We're going to have to really put the focused effort in, but the opportunities that we do get will be exceptional
Yeah,
investment opportunities
yeah,
for our investors. I do know that.
100%. I think the next like 6 to 12 months, John, will be looking back in 2 to 3 years
Yeah.
and we'll be going, wow, like that was a really great opportunity. There's a lot of things coming together, and we'll do some further podcasts on this as well. Like the data points just keep going on and on and on in regards to multifamily in these high growth markets, landlord friendly markets. And now is a phenomenal time. And you just think about back in history is like when it doesn't feel like real estate is the sexy place to be, that's probably the place that you want to go into and invest into. And like we're right at that time right now, and so really exciting. So if you are interested in learning a little bit more and potentially interested in one of our next acquisitions, because we are actively hunting, submitting LOIs, letter of intents, on potential properties. If you do want to learn more, book a one-on-one call. You can go to fulloutinvesting.com. There'll be some information there that you can check out, a sample deal and a opportunity to book a one-on-one call with either John or myself. If you like the show, you can go ahead and subscribe to the channel and share it with another high net worth investor that you think will benefit from it. Thanks for tuning in, and keep dreaming and investing big.